And as we talk about what's happening in China, what's happening in the U.S., the common theme is that things are slowing down from an economic perspective as the world economy faces one of its worst years in 3 decades. Our next guest says we're on the cusp of a loose recession. That's Morgan Stanley Chief Economist Seth Carpenter, and he is with us right now. Seth, it's great to see you. Obviously, there is a lot of glum talk that is out there. First of all, what does a loose recession mean?
What that means is when we look around the world and we think about the global growth rate, there are lots of countries, especially EM countries, that just are growing more rapidly on average because they're starting from a lower base. And so to use negative growth to define a recession globally sort of overdoes it a little bit. At the end of the day, though, it ends up being semantic. It's something a recession. If we're growing at positive 0.5%, if we're growing at negative 0.5%, that matters a bit, but we're in a situation where things are slowing down so much, the distinction between recession or not is going to be a little murky.
Seth, you're not looking for much growth in the U.S. next year. Walk us through what that growth looks like. What does growth look like in the first half of next year, for example?
Absolutely. So slowing down in the United States is, as it turns out, the objective of the Federal Reserve right now. They are raising interest rates, and we'll have another meeting coming up next week. They're raising interest rates precisely to slow the pace of spending and to get the economy to slow down. We think they're going to be successful, right? We see housing turnover. We're seeing some hints that durable goods spending is starting to come down. That's what they're looking for. So we think we get a slowdown. If you take jobs, for example, the last print was still pretty solid at mid 200,000. We think that continues to come down and eventually starts to get below 100,000 per month. We think it stays positive on average. So again, skirting a recession, but it's got to come down from where it is now if the Fed is going to be successful in bringing inflation back down.
So real quick, is GDP negative in the first quarter and the second quarter of next year?
We don't think so. We think it's going to be positive. We think it's going to be, about 0.5%, something like that. So skirting a recession, just barely avoiding a recession. We're still cautiously in the soft-ish landing camp.
So the Fed can say one thing and Powell can put out one message through a speech, through testimony, whatever that may be, but the markets can read something totally different and decide what they want to think about what Fed Chair Powell and some of the other committee members are saying. Does the Fed have a communication issue at this point, or is it how the markets are actually digesting what the Fed is signaling?
Option D, all of the above. We are in an extraordinarily difficult time to predict what's going on, to understand where the cross currents are. The news coming out of China that we just discussed, that's a rapidly developing story that has lots of implications for markets. And I think there really is inherently a lot of difficulty in understanding what's going on. When folks from the Fed talk to me about exactly this question and they say, what should we be thinking about for communication? I say, and at first they think I'm being flippant, but I say you should be as clear as you can be, but don't be any more clear than that. And there's just so much uncertainty right now. I think they need to be cautious in what they commit to.
Yeah, there's almost a danger of over-speaking. And I guess Jay Powell took that lesson to heart at Jackson Hole this year. But people are going to react how they're going to react. I do want to broaden out the conversation a little bit and talk about China, talk a little bit about the Eurozone, where we just got a better than estimated revision in GDP this morning. Sort of how lumpy is this going to look around the globe? Are there areas that are really going to hold up better?
There are almost surely going to be areas that will hold up better, but it will be messy, it will be lumpy, and there will be a whole set of confusing news flow. So for China, the news that we were just discussing is about what's going on with reopening. And I think one of the questions you asked is, what does it really mean? If there are restrictions lifted in some areas but not others, will people know what to do? I think on a global economic scale, there's also the question is, when the economy opens up, what does the demand look like there? And we know that households have been sort of locked in for a long time. The pent-up demand is probably more skewed towards domestic spending than it is historically, more skewed than typical towards services. And as a result, there's probably going to be less pull in terms of imports into China from the rest of the world. So I think the normal spillovers we get from a China acceleration are probably a little bit smaller this time than they have been historically.
Well, and the other question I would ask is, as we see sort of that last big economy reopen, have we learned the lessons from here? In other words, here we had all these pull-through effects and all of these strange effects that are now recorrecting and renormalizing. And we sort of knew it was coming, but we also sort of were surprised by it as it came, right? That we have seen these strange dislocations. Have we learned the lessons? Can we expect that in China as well?
I definitely think there are going to be lots of frictions as things open up again. Inflation has been actually quite low in China in contrast to a lot of the world where there's been opening up. And so I think there can be some frictions as people go back to spending and as they try to sort of increase the amount of services production that goes on there. So whether or not we've learned the lesson is in some sense off to the side. The fact remains, it's just really hard to open up an economy after a pandemic.
Seth, let's go back to the U.S. Is U.S. consumer spending just headed into a dark place? Are you talking about a job market slowdown, a potential recession, inflation is still high, and that is just a couple things on a long list of, I would say, even a low savings rate facing many households?
So there are lots of different cross currents. I would say one thing, when it comes to inflation, what we already see in the data is that consumer goods inflation is coming down. We've seen several categories of consumer goods where the month-on-month change has actually been negative. Automobile prices, used auto prices actually have come down for the past 2 months in a row. And so we are starting to see disinflationary effects there when it comes to consumer goods. Housing is clearly important when it comes to rents. That's rents or owner's equivalent rent, 40% of core CPI. What we know in terms of the new contracts, new leases, is that the rate increases for rents, that's actually stopped and is starting to level off. So in that sense, I think we are starting to see the beginnings of this disinflationary trend that we expect to happen over the course of next year. But interest rates have gone up a lot. Mortgage rates have gone up a lot. The housing market has clearly turned over. And that means lots of things. It means less housing, it turns out, but also people often buy durable goods to go along with their new home purchases, whether it's a new home or a used home. And so in addition to the higher cost of financing those durable goods,